video is on choosing between new tax regime and old tax regime. The video is divided in three parts. In the first part, we would be discussing the overview of the two schemes, the tax slabs applicable in the old as well as the new tax regime, and the benefits of opting in or opting out of the new tax regime. In the second video, we will be discussing the procedure for opting out of the new tax regime, and in the third part, we would be discussing the frequently asked questions on the new tax regime. This video covers part 1 of the series. New tax regime was introduced for individuals and HUFs in Budget 2020. Income tax slabs were altered and taxpayers were offered concessional tax rates in the new regime. However, the concessional tax rates were offered with a condition that several exemptions and deductions otherwise available in the old tax regime will not be available in the new regime. In Budget 2023, the government focused on the new tax regime, making it more attractive for the taxpayers. New tax regime was also made applicable for association of persons. However, it was not made applicable on cooperative societies. The scheme was made applicable on body of individuals and artificial judicial persons. In this video, the two regimes are compared for better decision making. Let us first check the tax slabs which are applicable in the old tax regime. Old tax regime refers to the system of income tax calculation and slabs that existed before the introduction of the new tax regime. In the old tax regime, individuals have the option to claim various deductions and exemptions to reduce their taxable income. This regime offers more than 70 deductions and exemptions. It may also be noted that the tax slabs also are divided into three parts. For individuals less than 60 years, association of persons, body of individuals and artificial judicial persons, the basic exemption limit is Rs 2,50,000. The second category is resident senior citizens between the age of 60 to 80 years, where the basic exemption limit is Rs 3 lakhs. The third category are resident super senior citizens of age 80 years and above, where the basic exemption limit is up to Rs 5 lakhs. Additionally, the tax rebate is also available up to Rs 12,500 for resident individuals if the total income does not exceed Rs 5 lakhs. Now let us see the tax rates which are applicable in the new tax regime for individuals, HUFs, association of persons, body of individuals and artificial judicial persons. The basic exemption limit is up to Rs 3 lakhs and additional tax rebate is available up to Rs 25,000 for resident individuals if the total income does not exceed Rs 7 lakhs. Please note, surcharge and cess will be applicable over and above the tax rates in both old as well as new tax regime. However, lower surcharge rate is applicable for high net worth individuals, HUFs, association of persons, body of individuals and artificial judicial persons in the new tax regime, where the surcharge rate on total income above Rs 5 crores has been reduced from 37% to 25%. Therefore, the highest effective tax rate has been reduced from 42.74% to 39% in the new tax regime. Also, please note that the maximum rate of surcharge on income by way of dividend or income under the provisions of Section 111A, 112A and 115AD is restricted to 15%. Also, in case of an association of persons consisting of only companies as its members, the rate of surcharge on the amount of income tax is maximum at the rate of 15%. With effect from financial year 23-24, that is assessment year 24-25, the default tax regime has been changed to new tax regime. So if you want to file your return under the old tax regime by claiming all the deductions, exemptions and losses, then you have to file it within the due date. After the due date, you have to mandatorily file under the new tax regime by giving up on most of the deductions and exemptions and all losses. Let us now compare the deductions under the old tax regime vis-a-vis new regime for financial year 23-24. Under the old tax regime, there are various deductions like standard deduction from salary of Rs 50,000, leave travel allowance, Section 80TTA and Section 80TTB deduction of professional tax under Section 16(3), house rent allowance, exemptions for free food and beverages through vouchers, food coupons, etc. under Section 17, subsection 2, clause 8, deductions up to Rs 1.5 lakhs under Chapter 6A of the Income Tax Act, deduction under Section 80CCD subsection 2, deductions under Section 80CCD1B up to Rs 50,000, medical insurance premium under Section 80D, interest on home loan for self-occupied or vacant property, and set-off of losses under the head income from house property. However, if you compare it with the new tax regime, in the new tax regime, only standard deduction from salary up to Rs 50,000 is available, along with deductions under Section 80CCD2 for employers' contribution to employees' NPS account. Along with this, under the new tax regime, there are some more exemptions and deductions which are available. That is, transport allowance in case of a specially abled person, conveyance allowance received to meet conveyance expenditure incurred as a part of employment, any compensation received to meet the cost of travel on tour or transfer, daily allowance received to meet the ordinary regular charges or expenditure on account of absence from regular place of duty, perquisites for official purposes, exemption on voluntary retirement, Section 10, subsection 10C, gratuity under Section 10, subsection 10, and leave encashment under Section 10, subsection 10AA, interest on home loan on let-out property under Section 24, gifts up to Rs 50,000, deduction for employers' contribution to NPS account under Section 80CCD, subsection 2, deduction on additional employee cost under Section 80JJA. Budget 2023 has also introduced standard deduction of Rs 50,000 under the new tax regime and deduction of family pension income under Section 57(2)(a). Further, Budget 2023 has also introduced a deduction of amount paid or deposited in the Agniveer Corpus Fund under Section 80CCH subsection 2 under the new tax regime. As already discussed, from assessment year 24-25, the new tax regime has been set as the default regime. Therefore, if you wish to continue using the old tax regime, you must opt out of the new tax regime in your income tax return or file Form 10IEA at or before the time of filing your income tax return. Form 10IEA is applicable only if you are having business income. Non-business income taxpayers will have the option to switch between the two regimes on an annual basis at the time of filing their income tax return. So in brief, it can be said that the benefits or the disadvantages of opting for the new tax regime or the old tax regime are: in the new tax regime, you have the reduced rates of taxes, but you have the fewer deductions available. In the old tax regime, you have the benefit of more than 70 exemptions and deductions. However, the disadvantage is that you have higher tax rates. Choosing between new tax regime and old tax regime is very easy. To know more, you can visit our website www.incometax.gov.in or contact our helpline numbers.